Hey everyone, this is Wyatt Hammond, the producer of the Industrial Real Estate Podcast. I wanted to take a quick moment to share an exciting update with you all. As the podcast continues to grow, we've decided to launch a brand new YouTube channel exclusively to the Industrial Real Estate Podcast. This new channel is where you'll find all of our future episodes, categorized past episodes, and all of the content you come to expect. So if you're currently subscribed to Chad Griffiths on YouTube, we'd really appreciate it if you'd take a second and head over to the new Industrial Real Estate Show and hit that subscribe button. This will ensure you don't miss any of the upcoming conversations, insights, and deep dives into the world of industrial real estate. We're excited about this next step, and we'd love to have you along with us. Just follow the link below this video or search for the Industrial Real Estate Show on YouTube and look for our new channel. Thanks, as always, for being part of the community, and we'll see you on the new channel.
Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by David Hansel with Lucern Capital Partners, an investment firm that focuses on industrial on the eastern side of the U.S. We're going to nerd out about all things industrial today. But first, David, thanks so much for joining me on the show.
Yeah, appreciate you having me. Looking forward to spending some time. Hopefully, what we share is helpful for everyone listening.
Yeah, that's always the goal, is just to have a non-formal conversation about industrial real estate in general. I always love hearing about your story, about how people get into industrial real estate, what they think of the market today, what they're looking for in industrial real estate from a strategy standpoint. And then if we could discuss anything with outlooks or what we think is going to happen in the next year, 10 years, wherever the conversation goes, I always just love talking about industrial real estate. So with that all in mind, what got you into industrial real estate in the first place?
So, I guess I'll go way back how I got into real estate and then eventually into the industrial. So, I'd started in the early 2000s in the brokerage business, flipping houses and doing new construction. And then in '07, launched a private lending company funding builders, developers, rehabbers called Alpha Funding. And that company still exists today. And a lot of the investors that backed us in that business wanted to get involved in the ownership side of real estate. About 9 years ago, we launched Lucern, and we started primarily with multi, some industrial, and in the last 3 years, we've fully pivoted over to industrial, multi-tenanted type spaces, small to mid bay. And we've been very active in that space and self-managing these assets that we currently own.
What was it in particular that interested you in industrial? Because I had a very similar origin story as well. I had started in residential and then found my way into industrial almost accidentally. But
Yeah.
a lot of people that had come into it, they saw something, they saw an angle, they saw something that was a little bit different. What was it about industrial that attracted you
Right.
to you?
Well, it's like the big migration right now. Everyone from multi is transitioning into industrial, right? I mean, or a lot of people are. I think what's kind of interesting to us at Lucerne was that when we started in the multi about 9 years ago, the environment was such that you had a lot of older ownership, an increasing market with rents, opportunities to come in and really do value add. The space was very intriguing. Interest rates were low. And you obviously had the diversity in tenant base. You kind of We kind of see a similar pattern going back 3 years ago when we kind of pivoted heavily into industrial, that it kind of feels a little bit like multi, but without all the headaches that come with multi, which is being heavily dependent on labor, which has become very challenging on the management side throughout the industry. I hear a lot of folks in my circles that talk about the same challenges that we saw with that. Your variable rate costs were very difficult to manage, as we've been through inflation, all these other issues. And when we dove in on the small, the mid bay industrial, we found that not only did it have the opportunity for short-term leases to market, where you could increase rents in multifamily on an annual basis if the market was allowing that to occur. But also we wound up seeing that there was a lot of this older ownership that had been in these spaces that weren't managing the assets to the fullest, that there was opportunity to come in and do value add. But back to the variable costs, we are able to either buy assets that are triple net leased, or we transition our tenants to that. So we really like the fact that your variable rate costs are very static, and helps you project and manage your asset a lot better. So I think having the ability to mark to market, not dealing a lot on the labor side, much easier to self manage, and the ability to push those expenses to the tenant base.
That was a fantastic way of describing that, and I hadn't heard that before, even though the concept is similar, but just describing it as variable costs, I think is a excellent way of describing the difference between multifamily and industrial is you're right, in residential multifamily, property taxes go up, in common area maintenance goes up, management fees go up. Those are all costs that don't get passed through to the tenant because most of them are on a gross lease, whereas an
Correct.
industrial having a triple net. I'm going to steal that actually. I'm going to start
Go
describing it
for
as
it.
variable.
Go
I
for
love
it.
it. I think that is such a great way of very clearly describing what that difference is. So on that though, so there's also a big learning curve with industrial because even everything that you said there with triple net leases
Right.
and that takes some. I guess I would say it takes some learning to really understand what that is. And industrial in itself is a lot more complex for the layman than multifamily. Whereas if someone's invested in housing and maybe they've flipped a few houses, it's not a big leap going from residential to
Right.
multifamily, but it is a big leap going from multifamily to industrial. So when you guys made that leap, how did you embark on the journey of really getting to understand what industrial real estate is and then also understanding the market?
So we had been following the market for some time, and actually, um, the first asset we bought just um, from the partners at Lucern to put our feet in the water without bringing our retail or our institutional investors along with us. And we're I don't want to sound like a negative word. We're pretty scrappy. We're able to dig in and get, deal with the tenants and help, turn the asset around, really focus on, renewing leases or bringing in new tenants, being aggressive in the marketplace. And we kind of found our way. We had good resources from the first property that we managed. We didn't self manage the first asset we acquired. We brought in a third party management company and learned a lot from that. After that, we've been able to self manage these assets and have done very well. But it's I want to say it's common sense in a way, but you have to look at your tenant base and make sure that you understand when leases are going to roll off, that you're projecting enough downtime and money for any particular build out or commissions, because commissions can be a big number in this space, depending on how long of a lease term you do. But, we just took it one step at a time, and, you know, we didn't there's definitely nuances, but we didn't find it as challenging or difficult to make the transition than most people might think. Again, we have a we have a great team. We're scrappy. We get in the weeds and make sure that we're on top of everything and following what's going on a daily basis.
Scrappy is a great word. And for any small, medium, or even sub institutional owner, I think being scrappy is the competitive advantage that levels the playing field because you can't picture a analyst or a senior director from a pension fund or a REIT going out and actually being scrappy. That's not a word that you would associate with those big firms. But for the small, medium, even some large investors that are willing to get their hands dirty and get in the trenches and work with their tenants, I think that does level the playing field. What?
What's kind of interesting, if you don't mind, what's
Oh,
kind of
please,
interesting
please.
is that the institutional investors, large institutional investors, haven't really found their way into the space yet, but they're starting to. And I'm going to make a big analogy, and hopefully it all fits together here. So, in the private lending company Alpha, we finance these investors, and we used to do that with retail capital. We'd fund a deal, and then we'd syndicate it out to investors. We had about 50 million of retail capital that we managed, and I talk about that because the institutional investors were sniffing around this space in the short-term bridge hard money lending space for a long time, going back into 2012, 15, 16. And then they found a way to crack the nut, so to speak, and get in and get the scale that they needed. And I'm seeing some of that in the industrial space right now, where these larger institutions want to get in because the yield is so attractive. But it's, as you were talking about, it's difficult to manage these assets for a group that was managing multifamily and doing that. It was an easy transition. It's like being on vacation. It's a lot easier to manage these assets once you figure out, how to set up your operation than it is to manage these multi. But we're starting to see some of these institutional groups come in, and I think there's a big play, kind of like there was in multi, to aggregate um, industrial properties together and then eventually sell off to a larger group down the road. And we're doing that out in the Charlotte MSA right now. We own a couple assets there. We're hopefully buying another one, and we think that there's an opportunity to sell up to a larger group. And I think that's going to continue to drive, pricing in the space, so long as the demand for tenancy and the tenant rates remain where they are. And all things considered, we think that'll happen. So hopefully that all made sense. But I think, I'm seeing a lot of that happening right now.
Yeah, it's very interesting. I think that is a great analogy, and I've gone back and forth on this so many times myself, thinking that a lot of these big REITs or pension funds or institutional money are going to shy away from the small bay multi-tenant industrial, just from the juxtaposition that if you look at a $5 million building that might be leased to a FedEx single tenant warehouse building versus a $5 million multi-tenant building that has 30 tenants in it, the management and the oversight and there's so much change in there. The FedEx is obviously a AAA tenant, whereas a 2,000 square foot tenant might have just a local plumber in there with no
Sure.
credit. And you're going to have all the issues that come with managing 30 tenants that all have needs, that are all turning over their leases versus that one single FedEx tenant. But if one thing is clear, is that there are big institutional players already in the multifamily space. So if they figured out how to deal with the smaller residential tenants, there is already a playbook on how to deal with it in industrial. So I do think as yields start getting compressed because we have so much vacancy in the big box warehousing, that these guys are going to start looking at other options, and small medium bay industrial looks pretty attractive right now. If they can
Yeah.
leverage that multifamily playbook and apply it to an industrial model, I think we could start seeing more of an influx into that industrial
Yeah.
space. So your strategy of trying to assemble a number of them and then sell it up to one of these institutional players, I think that could be actually a very lucrative playbook.
We're hoping so. And
Did
and
you
we
did you go into that with your exit, or do you still approach it that if it makes sense today, it could still make sense 10 years from now, whether you guys keep it or not, or are you going into it with that exit strategy in mind?
no, I think we obviously have multiple exit strategies with each asset, and we kind of see how things move along in terms of, are we moving the rents up according to pro forma? Are we beating it? What are the cap rates looking like? What is the opportunity to sell out? And we're opportunistic, right? If the right situation comes about, like we had one asset that we had acquired and only owned for like a little over a year. We were able to sell off. It was a 4 building portfolio. We were able to sell one building shortly after we closed at a massive premium to what we bought at a square foot. And then the other 3 buildings, that buyer decided they want to buy the rest of the portfolio. And our plan wasn't to exit that fast. We were moving rents up and trying to improve stuff, but we were able to deliver like a 1.5 multiple in a little over a year. Avoided the short-term capital gains. We're able to etch a really nice return for us and for our investors. But it's in the back of our mind that we can aggregate and have a a buyer upstream from us. But we're not married to that idea. The nice thing is that with these assets, there's really good cash flow on these assets that we've acquired and managed. It's getting harder to find those types of opportunities, but we're always digging and looking for that. So yeah, it's a multi-pronged approach, and we kind of look at what's available at any given point in time.
Hmm. Congrats on that exit. That's always a good feeling when you know that you made a great decision when you can exit that quickly and have such a big uptick on that. So congrats on that.
Yeah.
What do, what does your buy box look like? What are properties are you looking at, or what have you bought, or what are you looking for?
Sure. So I think our like absolute sweet spot is like a 50, 60,000 square foot small mid bay industrial, 2,000 to 10,000 square foot tenants in a high growth area with lots of residential, close to obviously major highways and up and down the East Coast. We don't want to be out in tertiary markets. We prefer, um, you know, we'll buy metal, but we think that there'll be over time, quality product is going to prevail. There's some really high sale prices on some of the metal buildings, and not that we won't buy them, but we think that a higher quality product will stand the test of time. And from a geographic standpoint, we're specifically Eastern Seaboard. We have a big presence in the Carolinas, and I mentioned Maryland, New Jersey, but we'd fill in the gaps in some of these areas in between. So that's kind of what we're looking at. I mean, as far as a small end, probably 20,000 square feet, in a market where we already own assets would be doable. And, probably a little upwards of 100,000 square feet is, where we top out in terms of size.
What would be your average tenant size?
So I was saying probably like ideally 2 to 10,000 square feet in that range. We have had as large as 20,000 square feet. Um, we're not opposed to having larger tents, but we like the diversification and, kind of ideally being under 10,000 per user is a great place to be and makes it easier to fill. I mean, for that matter, probably like 5,000 is a great place to land.
Hmm. And what's your average tenant profile? Are they more manufacturing, flex, light industrial? Are they distribution, warehousing?
It's kind of all of them, right?
Mhm.
We have everything from uh, HVAC and landscape to manufacturing, small manufacturing distribution. We have a lot of automotive in one property that we own, from like tinting and body work, things like that. We have import companies um, that and doing distribution. So it's a wide variety of tenant base.
Are there any tenants you stick away from? And I'll frame that question a little bit because the ones that I really try to stay away from are doggy daycares, which I think are just disruptive to all the other tenants and that they
Mhm.
smell. That's one that I'd always stay away from. Anything that could pose an environmental problem, like a chrome plating or something, I'd try to stay away from. Are there any that you would want to stay away from that'd be red flags for you?
Um, it's a good question. I mean, we don't have anything like a hard and no. Like some of the potential environmental can be actually interesting because well, obviously, we'll get a phase one and phase two if need be, but we'll also purchase and acquire environmental insurance, which we did on like this heavily automotive usage. And it just de risks the deal, even if there isn't anything that comes up. And there's usually better yield in those because not everybody wants to touch them. So you get like some better cash flow on it. And, we're not opposed to doing that. The doggy daycare doesn't sound like something I'd want to do either, but um, we're pretty flexible. We had one deal where we had a a um a marijuana manufacturing, like they would make edibles and pre-rolls and things of that nature. and could have been a phenomenal tenant, but our concern was that if you go to sell upstream down the road, some of these buyers don't want to have that use in there, so we opted to pass on it, even though it was a good option. So I'd say maybe that's something that that um, we have passed on, and would pass on, not because we don't think they'd make a great tenant, but it could affect our ability to sell down the road and get the premiums that we want to get.
I think that's such a great mindset to have, is to think what the future buyer will look for in the property just as much as what you're looking for right now. I think having that exit in mind is underrated. And I think more people would benefit from having that same mindset that you have. I want to pull on that thread that you mentioned about the environmental insurance. Can you explain that in more detail on how that process works and what's involved, and at what stage you would even get that in place?
So while we're doing due diligence and prior to closing, we would identify if the building, like there are two properties that we've bought environmental insurance on, and both had some flavor of automotive, one more than the other. And we got a clean phase one, but as an extra layer of protection, we just like getting property insurance, we got this environmental insurance, and I'd love to share the cost, but I don't recall off the top of my head. But um, it was important to us that the incremental cost was a peace of mind and still worked within the deal parameters, and just an extra layer of protection. But it would be done prior to closing, and you have to share the information with the insurance company. From the phase one and phase two, they'll do their own due diligence, and they'll put a quote out to you.
Do you roll that into operating expenses, the cost of that, or do you just have that as a separate cost of the corporation?
It's a one-time fee up front, and we just build it into the deal, so it's like part of the closing cost.
And the theory behind it is that presumably you have an environmental report in hand, whether it's a phase one or phase two, that doesn't have any additional recs in it. And the insurance would come into effect if you go to sell it 10 years down the road and an environmental problem creeps up. Is that
Yeah,
in
yeah,
essence?
actually, we did use the insurance once, that there were, containers that held, like, oil or oil, was these big containers on that sat on the property, 2 of them from one of the tenants, and they were plastic. Up here, and where this is down in the Carolinas, up in New Jersey, you're not allowed to use plastic, but that's what they have down there, and it had leaked, and we were able to use the insurance to clean up the leak and get a new tank in, to avoid problems. So that paid off, and it wasn't a massive expense, but it's still, obviously we weren't on the hook for it because of the insurance that we had in place.
I know you weren't expecting to talk about environmental insurance, but I just find this a fascinating topic. What is there an upper limit on what that will cover? So let's say something more catastrophic than a plastic container. Maybe there was some chemicals that actually leached into the groundwater and caused significantly more damage. Do they put a upper limit on what they'll cover?
So there are limits on it's kind of like any insurance, and it's like, each policy is its own fingerprint, so to speak, and you need to look at the particulars of the deal. It lasts for a certain amount of time. You buy it for 2, 3, 5 years or whatever. You look at, um, upper limits on it and what's covered, kind of like in a homeowner's policy. You can pay for extras like hurricane insurance and things of that nature. So the same thing goes with environmental. They'll offer you a suite of protection, and there are other pieces that you can plug in, to add to the policy or push limits or things of that nature.
Very interesting. Mark had a question as well. He's based out of Florida too. Two questions actually. He says there's a one-time payment for the enviro insurance, which you mentioned you did pay that all up in front. Is it based on how long you put it on for? The policy. I'm assuming it is. Like it's just all the levers that you pull if you want to have it be
Yeah,
10-year
yeah.
insurance.
I want to say I may be totally off, but I feel like for this one property that had that leak was like around somewhere in the low teens, like 13,000 or something to that nature. I could be off. I could circle back with you, but yeah, you just pay that up front, and it covers for the period of time that you agreed to and the coverage that you agreed to.
This is such a fascinating issue because it goes to just your common sense approach to de-risking as much as you can. I think industrial doesn't get the respect it deserves from the standpoint there is a lot of downside risk.
Yeah,
And it can even be just with the environmental. Someone goes and buys a property that has an environment, a phase one that doesn't recommend any further testing. Well, what happens if 10 years down the road, the property now does have contamination? Maybe the next
right.
buyer goes and does a phase one. It recommends a phase two. Phase two does some core boring and actually discovers that there's
Yeah.
higher levels of contamination. Now you have a dirty site. That very few people will actually take that into account, that possible risk. So is that what you're essentially trying to mitigate? Is you buy that insurance up front to avoid that coming down the road?
Yeah. I'll give you another example of the same mental process on a different aspect of the business. Like we're under contract with an asset, a 50,000 square foot new construction asset that we're buying at cost. The developer needed to get out, had a much bigger project that he's working on. We are under for a specific price. And the broker had given us some guidance on where the lease up pricing would be. We had an extended due diligence on it to see what kind of activity. And although we had some activity on the property, we didn't get any offers, and we had had this extended due diligence of 90 days. And to tie into what we were talking about before, we went back, probably about 2 weeks before due diligence was over. And we said, look, we're still interested in buying the property, but we didn't get the activity and we're a little unsure if the guidance is going to be true, that we'll still move forward. But we want a year's rent escrow put up. And then if we rent in month two, the building, you get all the money back. So it really put pressure on the broker and his client, the seller, to say, look, we're going to move forward if you put your money where your mouth is. And like, there's a lot of potential lease up risk. We thought the lease up risk would be lower, but we still found a creative and I think a positive path to move the ball forward. The seller, unfortunately, doesn't seem to want to play ball on that and may go back to market, which we're totally fine with. We were deep in on this deal and had a lot of pursuit costs. But, without that and seeing what happened during due diligence, we felt that that was a way to protect ourselves, and make sure that we're moving forward in the right direction. And I think that's the overarching theme of what we do. We always try to look at, without being scared of your own shadow, where can you protect yourself? Where do you want to take risk? Where do you not want to take risk?
Yeah, I think that's such a great option to have and to just roll it over into your acquisition costs. It's no different than paying legal fees or paying for any of the other due diligence reports you're
Yeah.
getting. You're just adding that in as a prerequisite of your own internal process. I think it's a great thing. So I'm glad you brought that up. I think it was really informative. The couple questions that came in, Mark had another one. Does the insurance work for dirty sites? So perhaps there's a phase two that identified contamination. Can you get the insurance on that, or would they just recognize that as already an issue that they won't address?
Yeah, in most cases, and I'm not an expert on this, but I think it would be like an exception to the policy, if it's a pre-existing issue, that's known. So you would have to likely look at what the cost is and negotiate that with the seller, and they obviously are going to have to deal with that with any other buyer that comes along. So there might be a policy that could cover it, but like, if it's a pre-existing condition, they're not likely to ensure that they would carve that out, is to my knowledge.
Yeah, I suspect it'd be similar to getting health insurance. That
Yeah,
if you had a problem or history of heart problems, they're probably not going to insure you for if you have a heart attack down the road, but they might insure
right,
you for other things. I'm assuming I have a reasonably good idea on how insurance companies work, and they do not like paying out if they don't have to.
right,
So if they've identified something already, they probably don't want to pay out on that.
right.
Uh, Has had a couple comments and questions as well. His first one loves the empire that you and Lucerne are building. He's out of Philly, so he loves your business model and what you're building. And then, White, if you could pull up the other one as well. We purchased a $300 million property in Philly that was a refinery and purchased environmental insurance for $4 million and has saved $172 million in environmental remediation costs for the things that the seller did not tell us about. Wow, that's a
Yeah.
big number.
Yeah, that's
Con
amazing. I'd love to hear the full story on that one offline.
Yeah, yeah. Well, Haas, I'll invite you to. You and I will need to do a separate interview on that because I think that there's a crazy good story in there. What a return on investment,
Yeah.
$4 million in insurance, which sounds absurdly high in the first place, but to save 172 million, that is a fantastic ROI. Let's discuss doing an interview on that, Haas. But thanks for
Yeah.
bringing that up.
I was gonna say, being in the business for, 25 years so, the one thing I know is that every day there's something new that comes up or another problem that you never thought could exist. So, when I don't want to say when you're younger, some people are conservative from the beginning, but like sometimes you have the "it can't happen to me" syndrome, and as you get kicked around over the course of your career and life and seeing challenges, you realize how important sometimes these things are and how it pays off when the proverbial hits the fan. So um, it's important to try to de-risk wherever you can. You work so hard to earn and make a lot of money in this space, and it can be taken away with a bad decision or not protecting your risk. We try to like take every risk off the table except for market risk, right? We want to have market risk, and that's about it.
I think that is such a great philosophy to have, and it's very similar to what I've said repeatedly as well. Is that the first thing to look for is all your downside risk. If once you can identify your downside risk and at least be comfortable with it, because you can never take it all off the table, even if you just get it to the market risk, that's something you can't control, and that
That
just is
of
what it
course,
is. But at least you've identified it. At least if you've gotten it down to saying, I've looked at all these potential issues that can come up, and it's just one thing that can derail an entire project and render it unprofitable or even much worse than unprofitable.
yeah.
So to try and identify that as much as possible is key. What else goes into your due diligence on that topic? I love how thorough you are and how much you try to identify that. What else goes into your due diligence process?
So there's a lot that goes in. Obviously, we go through and read all the leases. We put together, kind of a weighted average lease term chart to see when leases are going to come due. We try to we try to look at obviously all the rental and sale comps in the market to understand where we think pricing can move to, if it can be moved on lease up. We look at we put in conservative numbers for tenant improvements on fit up, which typically we're looking at like um, you know, dollars for turnover and commissions and things like that we're putting into our underwriting models. We look at the geographic area, what's happening with residential growth, because we see that as a indicator of sustainability in the properties that we're buying. What else? We obviously look at environmental, going through title and making sure that's all clear. We run the gamut on everything. Trying to think of what else, but that kind of covers a big portion of it.
Yeah, I appreciate how thorough you guys are on that. So you mentioned you're mostly on the eastern side of the U.S. on where you're looking. You mentioned Charlotte, New Jersey. What other markets have your attention right now?
So we own in Maryland, outside of between DC and Baltimore. We really like that corridor. It's very densely populated. There's more growth coming into that area. We're in negotiations on some new assets down there that hopefully will pan out. So we'd like to grow in that marketplace as well. Once we plant a flag somewhere, it's nice to bolt on additional assets. Um, you get some economies of scale, and it makes it easier for us, obviously, in terms of visiting and making sure we're going to the sites rather than jumping all over the place. So that market is a market that we're very interested in continuing to grow in. um, you know we're looking at stuff. We've looked at some stuff in some areas in upstate New York, but, um, you know, that's concerning with some of the tariffs that are coming down the pipeline and some of the imports coming from Canada down to the US and lumber, the issues that are going on with lumber. But back to your question, you know, I think from New Jersey you know, down to Georgia is really interesting to us. Florida is not so interesting just because insurance costs can be kind of outlandish. But it's a market that we've looked at, but we're not really focused too heavily there.
Yeah, incidentally, Mark is in Florida, and I have it diarized to invite him to do a podcast interview as well. And Mark, if you're tuned in, let's add that to the list of things to discuss is the insurance issue in Florida, because I've heard that in addition to David, I've heard that from other people as well, is that that's deterring people from considering Florida. So, David, maybe after we hear what Mark has to say when we do the interview, maybe it'll change your mind and maybe you'll consider
Yeah.
some areas
Well,
in
listen, it's
Florida.
another input in a deal, right? Like, you're going to input the cost of it, and it's just the cost to the deal. Um, you know, it's but it does get challenging. There's the uncertainty of what could change. Another big storm hits, or you're in an area where you get hit by a storm. Not that we're immune to it up and down the East Coast, but Florida is exposed a lot more than other markets, and the insurance companies have you know shown that by what they've done with the insurance cost.
Yeah, I agree. I think that that story is only in its early chapters right now, and I think that that's going to be a long novel on what it looks like as we read further into it. How are you finding deals right now? I know that's a question that comes up all the time, especially from beginning investors. How do you find a deal?
So we have two people that work almost entirely on acquisitions, and we're we're fostering relationships with brokers. We're looking in areas that we already own and pulling data. We're on property owners and contacts, and we're actually sometimes we go direct and try to source, or we'll go and give that to the brokers that we have relationships with and let them work it, so that it's a symbiotic relationship, right? We may give them leads to work for us, and obviously they're going to want to bring deals to us when they have them. They know that we're trying to help feed them as well. Um, we're just underwriting every deal that we have that fits roughly into our box, and just trying to grow that through these relationships. And obviously, once you close deals in markets, we try to promote that so that we could garner attention from other potential sellers, which has happened in the past. So just a multi-pronged approach, but it's a daily effort.
Do you track how many deals you look at versus how many you go into the underwriting process versus how many you close on? Do you keep any metrics like that?
We do. I don't know them offhand. Like, I know I was talking with my partner who oversees the acquisitions, um, and we had put out for Small Bay. It's quite a lot, like almost $300 million in offers over since the beginning of this year, and we've bought 2 properties,
Hmm.
so, totaling about, 9, 10, 11, probably about $12 million. So I don't know what that math comes out to, but it's been challenging, although I do think we've got a lot of potential deals in the hopper. We're negotiating stuff. I don't want to get too excited. Sometimes you think you're on a path to move forward and it doesn't come your way, but we're just pounding the pavement on a regular basis, and we're very diligent about what we'll buy, where we'll buy, and you know, like I said, we don't want to just go out to acquire assets just to acquire them. We want to make sure that there's a path forward to earn good returns for the principals and for our investors.
Oh, it makes total sense. What stops it from happening? So of 12 million out of 300 million, what's the barrier? Is it not agreeing on terms and price, or is it an issue that comes up in due diligence, or is it all over the board?
It's pretty much all over the board, but I would say most of it comes down to, pricing at the end of the day and the upside in those assets. So, we want to come in and, we're solving for project level returns a lot of times in the mid-teens, mid upper teens. So it's not like we're looking for, and we've been able to outperform a lot of our underwriting on the industrial side, just because either the markets continue to move up, we're good at what we do, combination of all that. But it's just the pricing isn't working on these deals. We can't get to a number that makes sense. And like I said, we're not looking for these grand slams, like bottom feeders. We're coming in with fair pricing that matches up with the leases that are in place and the cap rates in those markets. So it's either an unrealistic seller, or if something is going out wide in the market, we're starting to see some what we believe is overbidding because of some fervor in the space. And pricing just gets pushed up to a place where we can't justify it.
Yeah, that seems to be the commonality over the last 3 years as interest rates went up, is that a lot of sellers still have that 2022 pricing in their rearview mirror, and
Yeah.
buyers are saying, well, the pricing's changed and you need to reflect that. So it's harder to make these deals
Yeah.
pencil.
Well,
Have you,
interest rates have come down a bit, and we've
that's
gotten
what I was
some
going to ask
nice
next.
quotes. And I got to tell you, it's helping to make the deals more digestible. Obviously, if you can get some good debt, then it can help move the deal along, right?
Yeah, absolutely. And it doesn't necessarily move in lockstep as well, but interest rates coming down can somewhat be an indicator that there's pressure in the economy. Do you sense that there's always that trade-off that, yes, interest rates are coming down, but perhaps we're dealing in tougher economic times, perhaps there's more vacancy coming, or do you think we're just in a good spot right now for the foreseeable future?
It's a great question. If I knew the definitive answer to that, I'd be retired in the islands. Wouldn't be doing this. No, I still would be doing it, but I enjoy what we do. Uh, Listen, we're cautious, right? I think that there's a lot of uncertainty in the market, uh, with potential of recession and some of the tariffs and some of these other things could affect, tenants. And that's why, when we first started 3 years ago on really trying to build the industrial portfolio, it was a bit of a different environment in um, that um, that there was a significant amount of upside if you could move tenants out and mark to market the leases, where now we're kind of looking for longer weighted average lease time. So, like, where we favored short lease duration so that there was an opportunity for us to either bump up rents or bring in a new tenant at a higher level, we kind of are looking more at some of these assets that have a longer period of time on the lease to weather potential storms. It's much easier if things are challenge that tenants and businesses will stay and keep operating, versus having to find a new tenant to come in. So we kind of have changed a little bit of what we're looking for ideally would like in an asset, um, because of that. So we're taking that uncertainty into consideration when we're, you know, looking at these leases and these properties.
Yeah, great point on that. On the topic of interest, Has had another interest rates. Has had another question. I'm interested in learning about what your typical capital stack looks like on a middle of the fairway deal. So just an average deal. What does your capital stack look like?
So we're typically getting leverage somewhere between 60 and 70%, and the rest is equity. So we'll bring in, equity from the partners, and then obviously from from retail investors that have take you know sh- participate in our deals. So that's generally how it would pan out. We had one deal that we were the deal I was telling you about with the lease situation. We were coming in with a 50% leverage, and we were setting up that capital stack with a slug of pref equity to take the total leverage up to like 67%. Because once we leased up, we could retire that pref equity, with through a refi when we got to 70% occupancy. So we felt that, like, in that particular deal, there was a reason to take on that pref equity piece and blend it together. Our cost of capital was still relatively inexpensive during that bridge period, and then once we leased up, we'd be able to retire that and put long-term debt on that. But generally, 60 to 70% debt and the balance in equity.
You mentioned that you're seeing some attractive quotes right now on the financing side. Any come to mind on what you've seen recently in terms of interest rates?
Yeah, so we have another deal down in the Carolinas that we're negotiating that's right near some of these other assets that we own. We're just talking about this morning, and we have a 3-year swap fixed rate at like 5.8% from a bank that we do a lot of business with, that I was telling you before we hopped on. And that's very attractive versus taking a bridge. If there's some lease up on it, it's like, call it 70% leased, and there's two recent vacancies that are larger spaces. So, to we'd have to hold the debt for that 3-year period, but it's very attractive at those types of numbers.
Hmm. So what's your forecast for, I guess, finishing off 2025 and going into 2026? Any early thoughts on it, or is it take it as it comes and and adjust accordingly?
Well, we're seeing rates come down a bit, and capital that's been sitting on the sidelines getting a little bit more aggressive, which is a positive sign. We'll see how that continues, based on what the Fed does and also what the economy does. Um, I I hope and think that some buying opportunities are going to continue to shake loose. It has been a bit challenging, and there's been more competition in the space, but we're optimistic that we'll be able to find good, cash flowing deals. That if they're not stabilized, once they're stabilized, and um, you know, one of the things that we talked about before about from a risk perspective is like, hey, you know, is there going to be more, this recession, or our business is going to be hurting and going out? And one of the things that we kind of like about the small to mid bay space is that, you know, the big box is struggling a little bit. They overbuilt these major distribution centers, but you have users in the 50,000 square foot space, and 40,000 and 30,000, and some of these tenants, if things get difficult, these small to mid bay can benefit from downsizing from some of these larger tenant base. So we think that potentially, if there are challenges, that we can benefit by, bringing in other tenants that need to, like, kind of consolidate a little bit. But we're we're still optimistic that the long-term play on these spaces are going to be attractive so long as you buy well. But it is going to get more competitive as more people enter the space.
I always enjoy talking with other industrial people because I've found no matter where we are in North America, there's so much commonality between your market or my market or different markets all over the North America. So I completely agree with everything you said there. I think that was a very efficient and effective way of describing what we're going to see coming up. So I really do thank you for elaborating on that.
Yeah.
Anything that I missed? Anything that we didn't cover that you wanted to chat about?
Uh, no, I just, yeah, like I said, it's a great space, more competition coming. There's, there's still good opportunities to be found. Nothing particular. I'm glad we touched on the environmental topic. That's always interesting and probably not discussed too often. So
hmm
that's good. But I think, yeah, I think that's pretty much it from my end.
Yeah, the environmental is fascinating because it's not a cool topic. No, nobody's
Yeah,
making money on the talking about environmental, and it doesn't necessarily make riveting content. But from the standpoint of people that are interested in industrial real estate, it's imperative. We all need to be talking about it. So you're right. I think that is something that we need to discuss more on that. So I'll invite Hass on. We'll chat about it. We're going to invite Mark on to talk about Florida. Maybe convince a few people to consider Florida. And so we got lots of brokers, lots of owners and investors that tune into this, David. So if somebody did want to reach out, then maybe they have a property they want to put in front of you. What's the best way for them to contact you?
sure. Uh, Probably a couple ways. If you go on LinkedIn, David Hansel from New Jersey, Lucern Capital, and you'll find me there. You could email me at. You could go to our website, which will make it easier to reach out than me reading my email here. But if you go to lucerncapital.com, LUCERN capital.com, there's a chat bot in the bottom, and you can kind of fill out some info there or email info@lucerncapital.com and be happy to talk with you and get back to you on anything you want to discuss.
We'll put both of those in the show notes as well to make it easy for people to get in touch. I know that deals have happened as a result of people reaching out back and forth as a result of this. So hopefully it leads to something for you on that.
That'd be
Be a great
amazing.
story.
Yeah.
And
Um,
Mark said, "Thank you, David." And I has said earlier as well. He's a fan of what you guys are doing. So you've got some great support out there right now. And
he's a
I hope
neighbor of mine in Philly. Maybe we cross paths sometimes. We're running a big commercial real estate networking event on Tuesday of this coming week where people from all different aspects of the industry come out. If he reaches out to me, I can share those details. Maybe he wants to take a ride from Philly.
well, we have a couple minutes left. Tell me more about that because I probably won't get this one out in time, other than for Hassan and perhaps others who are tuned in. I probably won't get this out to get other people interested in it. But is it something that you do regularly?
Yeah, we do. We do once a month. Sorry, every other month. We do this commercial real estate meetup group, and there's capital markets guys. There's developers. There's in every asset class. There's all the third party service people that connect the dots for you. So it's a great. We found that there's a lot of networking in real estate, but there really isn't much on the commercial side where you get folks together. And we thought it was a great idea, and we've had some nice success with that. And I can share in the chat. I don't know if I can drop the link to it if you want me to, but
If you can, feel free. If not, just send it to myself and Wyatt, and we'll make sure that we get that out there. I agree with that as well. Is that there's a lot in the residential side, there's a lot in the multifamily side for networking, but there's not a whole lot on the commercial industrial side. So I'd love to help share this for people that
yeah.
want to network and get to meet other people. We'll make sure we include this in the show notes as well. So every other month it's in New Jersey, I'm guessing.
Yep. Yeah, it's I just dropped it into the chat, but it's for those that know New Jersey, it's right off of exit 109 on the Garden State Parkway. We hosted it a Lifetime Fitness, which oddly enough, the gym has a beautiful bar. You go to the gym to work out and you can go to the bar afterwards. So we have the bar and we do we provide free drinks and some food, and it's a great event.
That is a no-brainer for anybody in that area to go. If it's once every 2 months, that's a no-brainer. Has said he'll fly me out for the next one in a couple of months. Let's do the pod live from the event. That would be incredible. That would be such an awesome
Oh,
idea to
that's a
do.
pretty cool idea.
I love it. Haas, you're a genius. I think that'd be such a cool idea. Let's talk offline on that. Well, very cool. That's I think that's awesome. I know people are always looking for more opportunities to network with other people in the industry. So we'll make sure that we include that in the show notes as well, David. And I'd love to be there. I think that'd be very cool. Email theirs as well, so we'll include that too. David, thanks so much. This was awesome. I
Yeah,
thoroughly enjoyed it. It
I
was a great discussion.
enjoyed myself, and thank you so much for having me on. Hopefully, some of the info was helpful, and I'm thankful to be here. So,
Well, I learned a lot myself, so I'm sure others did as well. So thank you once again. Greatly appreciate it.